Hello. In this video, we'll continue with the deductibility of losses. Now recall that for a loss to be deductible under Section 165, you must have a loss and it must be sustained during the taxable year. Having a loss, there must be a realization event, which, going back to the discussion of gross income, where there must be accession of wealth, clearly realized, and dominion control, the realization component is the key there, with severance being important, and usually there's a sale or exchange component or some other type of implied sale or exchange where an event is actually triggered. So in this video, once you determine there's a loss, and once you go through the general rules of Section 165 and determine whether the loss can actually be taken, which 165 in itself is considered a limitation, now we have to consider other loss limitations. So assuming that the loss fits within Section 165C, the loss will be deductible unless some other code provision disallows the deduction. So some examples of major loss limitations include Section 267, related party loss limitations. So this is really what I want to focus on in this video. So Section 267A1 specifies the tax treatment rule which disallows the loss. So 267A1 specifies a loss disallowance rule. And we have to talk about what propositions or what this actually applies to. So the loss must be from a sale or exchange. So there must be a sale or exchange of property. So as I mentioned, when you're talking about a loss sustained during the taxable year, sale or exchange is very common, that triggering event, but there can be other events. So it must be a sale or exchange. And the parties in the transaction must be considered related under Section 267B. So the idea here is that if a related party is selling or exchanging property with another related party and there's a loss that he or she would recognize, or the entity would recognize with regard to that transaction, it can't be taken under this provision, under Section 267A1. So now we have to determine under Section 267B who is a related party. Who is a related party? So related parties, there's various classes. So the first class includes individuals and members of his or her family. So family members. And these include siblings. So there's all sorts of provisions in the Internal Revenue Code that deal with related parties, and what exactly is considered family member really depends on the section. So Section 267 is out there. There's various constructive rules, Section 318 when it comes to corporations, and each of them has their own definition with respect to family. So family includes spouses, siblings, ancestors, and lineal descendants. So spouses, those that you're married to, siblings, brothers and sisters, ancestors, and lineal descendants deal with the lines. So let's say you have you, right? People above you are your ancestors. People below you that come from your line are lineal descendants. So above you would be your parents, then grandparents, then great-grandparents, then great-great-grandparents. It could go all the way. Lineal descendants are people below you. Your children, your grandchildren, your great-grandchildren, your great-great-grandchildren, and so on. But notice you don't see anything on here about cousins. Cousins, right? Or uncles and aunts. You don't see anything like that. So it's only specific. It's only specific with regard to those parties. So next, the next type of limitation, the next type of Section 267B related party are a corporation and shareholder that owns more than half of the shares by value. So we'll just say corporate shareholder relationships. Corporate shareholder relationships. And specifically, must be owned 50%, owns more than half. So greater than 50% of the shares are owned by value. The third one deals with the grantor and trustee of a trust. So trust relationships, certain trust relationships, and not trust like, oh, do you trust somebody, but actual trust, like the actual type of legal item. And then also a trustee of a trust and any beneficiary. So we'll just say 3 and 4, trust relationships, being the grantor of the trust and the trustee. And then 4 is the trustee of a trust and any beneficiary of the trust. And then 5 is a corporation and a partnership if the same person holds a controlling interest in each. So for number 5, we'll just say a corporate shareholder relationship. And again, the key is that there must be some type of item that that makes them related with respect to ownership, controlling interests. So if you do have a related party, and again, there's a sale or exchange between the related parties, and any of the parties has a loss, that loss is going to be disallowed. Now, one thing I want to mention about spouses. If I know that Section 267B lays out spouses, and Section 267A1 specifies that, there's actually another provision in the Internal Revenue Code referred to as Section 1041 that deals, that's transactions between spouses and former spouses. And that actually controls over Section 267. But it really has the same type of effect here, just so you know. It actually goes further, but it has the same effect. So just so you know, if you ever have spouses, it has the same rule as Section 267 under Section 1041, but it even goes further. Now, there's one thing I want to mention, and that's the special rule of Section 267. The special rule of Section 267 deals with, okay, a second-level transaction. And I want to explain this issue, because this is a very common occurrence when a Section 267A1 transaction applies. So let's say the first level, you have a Section 267A1 loss that's disallowed. You have the loss disallowance rule that applies. So that's 267A1. It applies between parties. On the second level, what happens if the related party then sells to a non-related party? So a related party for a gain sells to non-related. So I'm talking about in the future. What happens if the loss is disallowed under the first transaction, but then let's say 5 years after that, the related party that purchased it in the first one, they sell to a non-related party for a gain. If that's the case, the party selling, the related party in the first transaction that's selling in the second to a non-related, they can, and there's a gain, they can actually offset their gain with the loss. You can't go negative, but you can offset the gain up to go to $0, or whatever amount can offset to make it a gain. But basically the idea is that the related party can offset using the loss that was not allowed, that was disallowed in the first one. So why do we have related party rules? Because in tax, there's this idea of economic units and themes, especially spouses. You can see it. Husband and wife are viewed economically to own the same property, to control the same property. The same thing with various family members, corporate shareholders, trust relationship, and corporate shareholder relationships. I'm sorry, this is corporate. Shareholder and partnership relationships. Partnership, that should be. I apologize. That should be partnership. Corporate shareholder and partnership relationships. Okay? So again, that's why we have related party rules throughout the Internal Revenue Code. There's all sorts of related party rules out there because of these economic, especially the spouse. Again, spouses, you see that. So I just want to talk briefly about some other loss limitations in general. That's how I'm going to conclude the video. So some other examples include wash sales, Section 1091 wash sales. And what this has to do with is, let's say you purchase stock and then you sell it a few days after that for a loss. And then maybe a few days after that, maybe 10 days after that, you buy stock again. And the idea is that you're trying to take that loss because maybe in a certain year you have high income, so you want to take the loss and you're going to reacquire the securities. A loss will be disallowed in that case, and then it'll be preserved for the future. Other types of loss limitations include capital loss limitations, which capital losses can only offset capital gains in some ordinary income. So those are some of the major examples of loss limitations.